how do you expect to get the business community to rally behind you when you're eviscerating the value of the stock market, which also is a revenue source for the federal government? It's just very bizarre to me. And I think we saw this over this past weekend. You're starting to see some of the media come out, kind of hit Trump pretty hard on this stuff. He may be starting to hear from some of his constituents in the business community of saying like, hey, like we're team Trump, but like maybe tone down the recessions are cool rhetoric.
Hi everyone, welcome to Bits and Bips, exploring how crypto and macro collide, one basis point at a time. I'm your host, James Seyffart, TradFi Archmaester, Lord of Bloomberg's End, here with Joe McCann, Lord Commander of Asymmetric and Master of Bonk. Also joined by Noelle Acheson, High Seer and Keeper of the Crypto is Macro Now newsletter.
Hello everyone.
And finally, Ahluwalia, Maester of Wealth, Leader of Lumina.
How's it going?
We're here to discuss the latest stories in the worlds of crypto and macro. Just remember that nothing we say here is investment advice. Please check unchaincrypto.com/bips for more disclosures.
Crypto moves fast. It's why Bitwise launched the weekly CIO Memo, a jargon-free summary of what's moving crypto markets, written by one of the best in the business, CIO Matt Hogan. Get up to speed in 5 minutes or less. Check it out at bitwiseinvestments.com/CIO Memo. Carefully consider the extreme risks associated with crypto before investing.
All right, we got a full house with no special guest, actually. So this is, I don't remember the last time we had one of these where we had four of the main crew. So this will be fun. Well, let's get into, we got to start with macro. I feel like that's the main overarching thing. I feel like there's really not a ton happening since we spoke last week, or it feels like there's not a ton happening, but there's a lot happening on the macro and geopolitical front. I mean, there's a lot of talk recently about, a stagflation trade. There's a lot of, I'm going to read a tweet from Noah Smith, who's an opinion columnist actually for Bloomberg. And he said, Trump and the Senate GOP are asking for trillions in tax cuts. Interest costs and the debt are soaring. Medicaid cuts won't make up for it. DOGE is not cutting spending. Tariffs are just going to hurt economic growth. My friends, we are in trouble. And there's been a whole bunch of other things. Reuters put out stuff. We had other Bloomberg reporters put out different pieces. This seems to be the hot topic of like the last, less than a week, I guess. I'll turn it over. Like Ram, what are your immediate thoughts on this? And then go to Noelle and Joe.
So there's a gap in the perception of inflation and actual inflation. If you look at like Trueflation, other metrics, inflation's coming down. It's coming down in goods and services. Labor pressure has also been softer. That might change in the future, but so far so good on that. I think the perceived inflation is higher because you have products like eggs, which have gone higher, and people anchor to that. They look at mortgage rates, they anchor to that. But the reality is there's actually more freedom that the Fed has. On DOGE, I'm not so sure why people are so skeptical about spending cuts. I don't know the size and scope of what cuts we'll find there, but I think at least over 100 billion. I mean, the question is, can you cut fraud from Social Security, Medicare, and Medicaid? The numbers that Elon shared on Twitter were that there's like hundreds of billions of dollars, and that's fraud that's going to American consumers, by the way. I think one thing you've figured out is, those are American consumers paying for Netflix subscriptions, Amazon orders, cars and houses and all the rest. Maybe grandma and grandpa passed away one day and they're still collecting a check. I imagine that's the nature of the fraud. I'd want to size and scope that, but I don't know why so much skepticism. On the tariff stuff, tariffs on China really aren't a big deal. They really aren't. Like, it drives furniture costs and, it's not a material driver of consumer spending anymore. And there's so much natural deflation in China manufacturing. The tariffs to watch are Mexico, because they're a significant trading partner. Tariffs on Canada really don't matter, and they're probably not going to go away. But as for tariffs on Mexico, Trump apparently has a good relationship with the prime minister, number one. Number two, fentanyl interdictions are down substantially. 3, Trump is getting earful, no doubt, from GM and Ford and other leaders from business roundtables saying, hey, we have production. 4th, Trump needs a strong, economically viable Mexico to stop the flow of illegal immigration. If Mexico becomes a failed state, you get worse issues. And lastly, if you need an alternative to China production, it's got to be Mexico. So for all those reasons, I expect Trump will find a deal with Mexico, and that's the one that matters. We have more trading with Mexico than Europe. So I think that's a story people are not talking about.
I'm going to push back slightly on a couple of things there. But first of all, the inflation expectations, obviously not tethered to actual inflation, but the danger is that actual inflation responds to those expectations. I'm not just talking about the behavioral changes that inflation expectations trigger in consumer purchases. I'm talking about corporates looking at inflation expectations and thinking, they expect inflation, so we might as well raise prices. And that's another way we're going to start to see inflation come back. On the tariffs, I'm also going to argue that the tariffs themselves aren't the issue. Tariffs, we can adapt, it's going to hurt, etc. It's the uncertainty around the tariffs that is having everyone totally paralyzed, and that's where the big hit will come. Once we get greater certainty, which hopefully will be in a few months, hopefully someone will talk some sense into the dialogue going on, then we just, we adapt, we work around them. And then over to the stagflation trade that you were talking about, James. It's a confusing term, and there's no set definition to what even the stagflation is. There's no set definition to what stagflation means. For some, it means stagnating growth with high inflation and high unemployment, and for others, it means declining growth. It depends. Stagflation trade typically involves defensives and commodities, but commodities, the outlook for them is totally up in the air. It's oil, for instance. We've got the US bombing Yemen and blaming it on Iran. We have Syria marching to Lebanon. Any conflict in the Middle East could push the price of oil up. But otherwise, with stagnating growth, especially with declining growth in China, the oil consumption in theory is coming down, especially with OPEC actually increasing production come April. And copper and everything, where's the demand going to come from? Again, unless the Ukraine war finally draws to a very painful close and building recommences. We just don't know. It's all up in the air, and geopolitics is playing a much larger role this time round than the last time we were actually talking about stagflation trades.
Yeah, I think I'll build on a little bit of what you just said, Noelle, because you bring up a really good point around commodities specifically. It's like, where's the bid going to come for these things? And ironically, the tariff talk has led to, I think, an under-discussed topic around what's known as the repatriation trade, which is today, NIIP is something like $23 trillion in the United States. That's effectively foreign investment directly invested into the U.S. A lot of that's starting to go home. And so you're seeing this in places like Germany, in Hong Kong, et cetera, and it's being reflected in the stock, the moves in the stock prices there and ultimately the stock markets. But you can couple that with the stimulus that these countries are now alluding to. So in Germany, they're talking about €1 trillion of stimulus. They finally got off the debt break and they were like, it's time, let's go. And that could be a reaction to the uncertainty around tariffs. It could be a reaction to the rhetoric out of DC and the Trump administration. And are these really our allies? I mean, that's probably like the most extreme case. But I do think that a lot of this stems from the uncertainty around the tariffs. To your point, it's the uncertainty around it. In fact, there's the uncertainty index is at the highest level it's been at in years, which should not come as a surprise given how uncertain things are, right? So I think as that relates to things like commodities, where will that stimulus money be spent? I mean, if China really starts to stimulate, look, they actually now have, I think they came out and they said, we still want to hit our 5% GDP target and run a 4% deficit. It's the highest deficit in decades. That's pretty meaningful. Now, it's China. They talked about some things back in October, and we didn't really see a lot. But with the dollar declining, they actually have a better chance now to run a higher deficit. And so I do think that if China starts to stimulate to the extent that they are suggesting, you may end up actually seeing a bid for commodities, irrespective of the tensions that are brewing in the Middle East. Oil, actually, I think I saw something today, oil hedge funds are the least long or the least positioned in crude futures that they've been in ages. That's typically a time to get long. You could have some other idiosyncratic event in the Middle East actually trigger this, but I think longer term, if these stimulus packages pass in the rest of the world and the developing world, you're going to start to actually, I think you have to see a bid actually come back to commodities.
Yeah, I mean, I'm going to share this for anyone watching. This is just looking at trueflation, which I know is kind of, some people love it, some people hate it, but it has been pretty good so far in leading what the CPI numbers are, and it just kind of goes to show what Ram was talking about, that inflation is actually coming down, and I mean, it basically has fallen off a cliff since the numbers have come out in the most recent thing. So I think that's part of it. Obviously, what you spoke about, Joe, is like everything is extremely uncertain. Like the whole talk was take Trump seriously but not literally, and that's kind of like now everyone's saying, okay, maybe we should have taken him seriously
Right.
because of what he's doing, and I think it's more about like just no one can plan for this. I mean, we had small caps are off 20% from where they were at the highs, right? Like this is not some baby little sell off. I mean, large caps are off 10% ish. So
Yeah.
I mean, it's all because of the things that like we talked about last time. There's so many cross currents and so many things, and no one knows what's happening. And part of it is like how much of it is he's just trying to negotiate and put something out there, and he knows he's going to settle somewhere lower. But like he can't act like that's the point of it. Even if that's the case, and it is more of a
Well,
taken literally, not seriously.
it's super strange, like the approach that has been taken by Scott Bessent and Lutnick and other members of Trump's cabinet. On the one hand, I just do want to point out, if you look at inflation expectations by party line,
yeah,
I mean, they are so radically different. So yes, my inflation expectations are aligned with, if my party has a person in the White House or not. But let's think about this, right? They want to get the deficit down. They want to, they want to get yields down. They want to get mortgage rates down. They want to figure out how to balance the budget, and et cetera, right? So wiping out $5 trillion of the stock market is a good way to do that. I mean, it's just mind-numbing to me.
Do you think that, Joe, is that intention or deliberate or?
No. I'm saying that's the net result, right? Like you saw Trump come out and basically say like he wasn't definitive as to whether or not he was okay with a recession. You've seen Bessent kind of be like, yeah, corrections are healthy, and yet that type of language is very different than Trump 1.0, right?
Extremely different.
Look, when you wipe out $5 trillion worth of market cap in stocks, that's 12% of GDP now. That is a major amount of capital that's just been eviscerated. And furthermore, the folks that actually own stocks, which is not the majority of Americans, are going to pull back on spending due to the negative wealth effect. So and finally, let's assume that the stock market ends here on December 31st. Where's the cap gains revenue coming from? So if you're actually trying to generate more revenues for the government, you probably need to stimulate assets, or at least keep them, up to some extent. And so the washout has been very strange. Like to James's point, I see this a lot because when I've talked with a number of folks in the industry about this, you see the headline of S&P is only down 10%.
Yeah.
Right. If you look underneath the surface, first of all, usually when you have like these types of pullbacks that are quick moves in the VIX, correlations are super high, meaning most stocks are down, right? Correlation was super low this time, and then dispersion was super high. So the concentrated stocks like the Mag 7 got decimated. Palantir down 40%, Robinhood down 50%. I mean, these moves at very specific stocks hit retail for the most part, right? And so to me, again, like I question the messaging approach over the past few weeks, given the kind of mechanistic selling that has occurred. I know there's a whole topic we could cover around multi-platforms and factors and all the stuff that happened in the markets, but like, how do you expect to get the business community to rally behind you when you're eviscerating the value of the stock market, which also is a revenue source for the federal government? It's just very bizarre to me. And I think we saw this over this past weekend. You're starting to see some of the media come out, kind of hit Trump pretty hard on this stuff. He may be starting to hear from some of his constituents in the business community of saying like, hey, like we're team Trump, but like maybe tone down the recessions are cool rhetoric.
Yeah, no, I was nodding my head as you were saying that. Look, Maria Bartiromo and quite a few others that are center right are asking Trump tough questions and with follow-ups. But they are starting to soften the tone, right? Bessent last week said, hey, we need a detox. But then this Sunday, I Meet the Press, he said detox doesn't mean a recession. So they are starting to soften that a bit. Look, I think this is reality TV presidency. Trump is very deliberate about that. He said, this is great television after he ejected Zelensky. He's very conscious around that. And they're iterating on policy in public, right? Tariffs have shifted from universal to targeted and reciprocal. But I would say that peak policy uncertainty is bullish for forward returns. So, here we had a 10% correction in the S&P. Markets love to rug pull. You get a 10%, nice magic number like that, get a lot of headlines, Drudge Report indicator flashes. I don't know if we had a CNBC markets in turmoil. And now you've got 2 back-to-back strong days in the markets. So we haven't had that in a while. I'd expect where we stand today on Monday, I expect we retrace a bit tomorrow going into CPI. But, as I look around markets, things are very bullish now. Like animal spirits, your point, you mentioned Robinhood and Palantir. Things look poised to rally and are rallying across the board. What you're seeing is capital leaking from Mag 7, which was a consensus crowded trade and idea for the last 2 years, into everything else, into the breadth, into the 493, into international. Even Mexico is up like 12% year to date. This thing with these tariff issues with the United States outperforming.
The thing is, one thing to bear in mind is the timing of all of this. Trump and his team have an agenda. They want to bring spending down. They want to put the deficit back on the right track. And now is the time to do that. The short-term pain means that come the midterms, things will be rallying again, and they will be able to say, look, we did it. So I think they are actually willing to withstand the pain, the hit to the tax revenue, the whole sentiment thing as well. Now is the time to do it. Trump doesn't seem to give a shit what people actually think of him, and he's not running again. So this is the only opportunity the United States has to do that kind of thing. I hear time and time again about how, nothing stops this train. Of course, we're going to be stepping in to continue spending to protect the economy. And of course, there's a Trump put in the market. Of course, none of this can continue to go down for much long. But then I'm also hearing from others, very intelligent people, such as, for instance, Fed Chair Jay Powell, saying this is unsustainable. Now, which is true? Are we going to continue to spend, or is this unsustainable?
Do you have a view on DOGE? Like, are the cuts credible and real, and to what amount? Like, if I can figure out one thing, that's the variable I would really want to understand. And the related is a match with tax cuts.
Yeah, my view on that is that it's material. I mean, a billion here, a billion there, soon you're talking about real money, right? But it is just scratching the surface for what needs to be done. The 2 biggest sources of expenditure are interest and defense. And interest will come down as the yields come down, and they're doing pretty well on that front. And defense spending is going to come down if Europe is paying for more of itself, if Japan is paying for more of itself, if Australia is paying for more of itself. So they're on the right track for that as well. Short-term pain, and then this time next year to be able to say, look, we actually made a difference. And that makes the midterms a very different outlook.
Yeah, that's a great point. I mean, the one thing I may slightly disagree with, or maybe I'm agreeing, I can't recall if you mentioned this or not, Noelle, but I was looking at the CRFB's impact of the current House reconciliation bill, and it's 8 times the size of the 2022 infrastructure bill. 8 times. So the irony is there is this narrative of this is unsustainable. We need to get, interest rates down. We need to control the deficit, et cetera, and control spending. Yet this bill is like $2.8 trillion. It's huge, right? And so within there's a lot of stimulative things on the tax cut side. I think one of the things that stood out to me that I don't think gets a lot of press is interest rate deductions from automobile loans. Right? Like, how stimulative could that actually be? How many average Americans actually have car loans? Almost all of them, probably, is my guess. Imagine, that little bit being in there. What could that actually be? Could that actually be a material stimulant for the broader market? But I actually don't think that. I don't think the Trump administration believes that they're not going to be continuing to spend loads of money, because it wouldn't show up in this reconciliation bill. They are going to continue to spend lots of money. And so as those deficits continue to rise, we need to get rates down, how do we go about doing that? Well, we talked about the tax policy, or tax revenues is one. I'm sure there's some impact that DOGE can have. But the other thing about DOGE, and this is just my own opinion on it, is I don't think finding all the waste and fraud and abuse is pulling that cash out of the market. I think it just gets reallocated to something else, right? Like the money's already there per se. Instead of it going to some random country for some random, ideological or social, program, it goes to defense, right? Or something. It goes to one of these 5 buckets that the Trump administration is comfortable spending that money in. One other thing I will mention about the recent stock market rout is, yes, a lot of it is sentiment driven. You talked about the breadth broadening out, which is great. We haven't seen that in a very long time. The mechanisms for how this stuff actually sold off was almost like textbook systematic selling. And so let's talk about what I mean by that. First, those crowded trades, the Mag 7s of the world, crowded longs, as you like to call them, in hedge fund speak, those all got rapidly unwound quickly. Why? And so if you dig into it, what you learn is these large hedge funds that run multi-platform, they're multi-platform hedge funds. They have these things called pods, which is usually like a PM, a trader, an analyst. They manage a couple $2 billion, and they can be focused on a sector like industrials, or they can be focused on a factor-based investing model like momentum or beta or realized vol or something to that effect. These pods have billions of dollars, and there's dozens of them across all these multi-platform hedge funds. And these are like your Millennium, Citadels, Balyasnys of the world, Point72, et cetera. That's about $400 billion it wrapped up in that. That's about 10% of the market, but they use leverage. So that leverage is actually closer to 3 to 4 trillion notional. And so when there's a de-risk event across these pods, they all have to de-risk at the same time. Well, if they're all running the same factor models, or they're all in the exact same longs, guess what? They now have to degross. They got to de-risk. We all have to degross. We're all degrossing at the same time. And it creates this kind of violent feedback loop. That's why you end up seeing the Palantirs and the Teslas of the world down 40, 50%, because there was forced selling. Has anything fundamentally changed for Palantir in the past 3 weeks? I don't think so. Has anything fundamentally changed for Tesla or NVIDIA? I think for the most part, the answer is no. And so this, just to finish the thought, Ram, the selling that occurred as kind of depending on where you were hiding out was really aggressive. And that was also a continuation of what was happening with the VIX. People were trying to hedge, but the VIX was just marching higher. So now you have vol control funds have to sell, right? So this was mechanistic selling through the markets. I'm not suggesting that this is the ultimate bottom of the year or anything like that. But man, it just feels like there was some forced liquidations out there. A lot of these pods blew up, and now we're reset and time to regross again.
So first off, fully agree with all that. This is a momentum factor unwind. Momentum is an incredibly effective and powerful factor for generating risk-adjusted returns that outperform the market. And you had Citadel and Millennium turn in negative returns, which is very rare. But there are other considerations too. There's a wonderful quote from John Templeton where he says, bull markets die in euphoria. Shortly after the inauguration, we had euphoria. Trump was at the UN saying, we're going to lower interest rates, America first, rah, rah, space rockets, all this stuff. And there was over-positioning everywhere, right? Including from retail investors, which sent Palantir to 400 times PE ratio. So meanwhile, you had investors like Warren Buffett that were building cash, taking the other side of that to enable other people to get long. So yeah, you had peak sentiment conditions. You had euphoric conditions. And the top of the market of the day was when Trump ejected Zelensky from the White House. That scrambled everyone, set up a risk aversion. Things were priced for perfection. And then, we've reset since then.
Yeah. I mean, you also had them it was almost impressive. Everyone in the administration was walking down risk assets in the way they talked. There was no defending it whatsoever. They were kind of here we go. And they keep talking about they want the 10-year lower, which again is still sitting, what is it at right now? 4.3 almost. So it's actually up a little bit from last time we did this.
I mean, is wiping out $5 trillion worth of the stock market good enough for 30 bips drop in the 10-year?
It should be lower. The 10-year, I would have guessed if you told me that market dropped that much, I would have guessed the 10-year would be at 3.9 or 3.8.
Same. I completely agree. Which is also why you're like, hey guys, maybe you should pay attention. This isn't working.
On September 30th, I want to say, like the 10-year was around 3.5-ish, somewhere in September.
3.6 in middle of
3.6.
September. Here, wait, I'll share my screen. One sec.
And that's when you had a growth scare is too strong a word, but you had concerns around slowing growth, which is the concern now. And you didn't have that severe correction. Now, the difference between now and September is you have bond yields in Europe are attractive, and they're competing for capital now. And you have foreign markets competing for capital. So it's
That's right.
It's not. There's decent chances that we bottomed right now, and that we're going to rally for a bit. Notwithstanding kind of a quick kind of little pullback here, but the situation is like dicier than September in a sense, like. And if you look at Q4 2018, it's a study I keep going back to. You had trade wars then. It was also Trump 1.0, and you had a 19% correction, and the 4 PEs in the stock market were around 16 to 18 times, by the way, which is much lower than we are now. And year-over-year earnings growth back then was 20%. Now it's 8%. Higher valuations, like I guess you call it the PEG ratio of the S&P is higher, and so it's a very interesting situation where we're in versus September.
Oh, I completely agree. And I think, the other way to look at this is, I wrote about this actually at the beginning of the year. I was like, the easy money is over. 2024, certainly for like Bitcoin and crypto, it's like Bitcoin ETF probably going higher. Like it's relatively easy construct, right? Like, this year it's going to be much harder. And furthermore, when you look at back-to-back 20+% years in the S&P, the third year is very, very difficult to pull that off. Now, we haven't started to really see forward earnings estimates come down. I think that's going to be the thing that's going to really start to pinch the stock market if we actually haven't bottomed. I think there's been a few here and there, but for the most part, I haven't seen like across the board changes in earnings expectations, which frankly, if the consumer is slowing down or you have this negative wealth effect or whatever, high inflation, you name it, earnings are going to suffer. So they're probably overvalued. But then could all of a sudden there is this, 180 by the Trump administration that says, we're printing $1 zillion, or we're going to do massive stimulus, or we're going to do this enormous tax cut, or whatever the thing may actually be to kind of stabilize those markets so that they can continue higher. I just don't know.
Right. So the big question is, how do you position in all of this, given these other asset classes? But on the earnings estimates, so within consumer discretionary, they were slashed, and in energy, and I believe there's one other sector. And if you look at the XOY ETF, that's down 18%. So it's already priced in a lot. Notably, Tesla down again today, about 6%, while everything else kind of rallied today. So I think markets have discounted quite a bit of the tariffs. The fundamental question, though, is around how do you position against this backdrop? Because I agree, the easy money is made. This is more like advanced class. Now, this is like a difficulty 9 gymnastics in the Olympics at this point.
Right.
Noelle, any thoughts on that before I jump in?
No, totally agree with what they're saying. The uncertainty is the key. Liquidity is something we also need to think about. Liquidity, not only in terms of money rotating into other markets, but liquidity in terms of there's a massive wall of debt maturing this year. 33% of outstanding debt matures this year. How are they going to refinance it, especially since much of that was taken out during COVID at very low rates? So liquidity is, in my opinion, more likely to head out of the market than come in, which is going to affect risk sentiment, which is going to affect the stagflation trade, et cetera, unless there is liquidity coming in from other sources.
So I think that's a phenomenal point, by the way, is can you refinance the 5-year money that was borrowed at 1.5% plus a spread 5 years ago coming due? Here's a question, though, like who is at risk of refinancing or of a failure to refinance that is material market cap? It's not Walmart. It's not Costco. It's not Mag 7. I mean, those are bubbles, especially I think Costco and these guys are 49 forward PE ratios. They probably reflate a bit before they roll over again. Same thing in Palantir. But leaving that aside, I think it's a central crime. I'm genuinely trying to figure this out now. I don't see I see credit risk in commercial real estate. I see the risk all over that, yes. And that's been a slow-moving, controlled demolition. and we're 2 years into a 5-year demolition. But you look on the East Coast, you have names like SLG, which are not too far off from their highs, or Vornado. They've all rallied through return to office. I actually bought a stock called HPP. It's a West Coast-based, SF-based commercial real estate firm. I think it's a back from the dead trade. They've got a shit ton of debt to equity, but you've got these VCs that are funding AI startups, and they're going to office. And if they can pay their debt, it's like I buy a call option with an equity-like risk feature, and the lows are behind me. So I think, Noelle, you're raising the right question. I just don't see where the big debt issue is. It Barnes and Noble? Who cares about Barnes and Noble? Barnes and Noble probably goes away. Bed Bath and Beyond goes away. Okay, retailers are in pain. People are shifting to Amazon, and they're shifting to Walmart and Costco. Dollar General, Dollar Tree, they're fine. Yes, they are losers from a retail behavior perspective, but I don't know that it really matters other than commercial real estate. That's where the debt issues are.
Well, what if I told you that there's a solution for the corporate bond market to have a 0% interest rate as long as you use that money to buy Bitcoin?
Issue preferred stock and convertible debt.
Yeah. Now you're targeting all the bond guys. You're like, oh, wait, I want in on this Bitcoin trade. That's all you got to do. Just refinance it at 0% and use the proceeds to buy Bitcoin.
And we've been wondering where the new demand was going to be coming from. Now we know.
You know who should do it? I'm going to share my screen here. This is the U.S. government's debt distribution. There's about $9 trillion that needs to be. This is the maturity schedule.
That's why Bessent wants to talk down rates. He just wants to refinance all the bonds he's issuing.
But still, that is $9 trillion that's going to be refinanced higher.
Yellen left him one hell of a gift on the way out the door.
Yeah. I mean, he was complaining about this long before I think even most people were thinking he'd even be remotely related to Trump. And
he was right. I mean, that was a massive liquidity injection by going short term. And now he has his hands tied. He can't really unwind that, even though that would be the right thing to do.
He's absolutely right. And the insanity of the U.S. government not terming out their debt when rates were 1.5% below inflation and nominal GDP growth. That's a kind of a negligence at the level of the Secretary of the Treasury. But there is one way to fix this issue, or a potential remedy. It's called free trade. Because if you can trade with China, when we import from China, we're handing them US dollars. They can turn around and buy US capital assets, which are bonds. They're not buying our exports because they don't need, and we won't sell them, NVIDIA GPUs or F-35. So that's a solution, right? Like, the issue is that this policy approach has conflicts. If you're trying to punish China, I'm all for tariffs on China, actually, the bad actors. But if you do that, then you're giving them less dollars to the world to go buy your bonds. So these policies are at issue with each other. They're in conflict with each other.
Noelle, I'd love to kind of get your broader take on this because you really, I think, were one of the first people to, certainly in the broader kind of Bitcoin crypto community, champion the fiscal dominance concept. And I have absolutely come around to it. I was a little skeptical, but I got to give you some credit. Like, I have come around to it, and the Fed is really, fucked, frankly, because, you look at this $9 trillion that needs to be refinanced, but at how are they going to get yields down to refinance it? Well, maybe if the Fed cuts rate, I mean, the 10-year is trading below the effective Fed funds rate right now, right? They want it even lower. Well, what if the Fed cuts rates? Well, if they cut rates, we have the potential for inflation all over again. Even though the trend is lower, I do think we're going to be approaching 2%. But what is your take on this? Like, if you could wave a magic wand from your fiscal dominance purge, how do you fix it?
The way to fix this, you make America the best home for capital in the world, which it was. And the proxy for that is the USD JPY. It's a measure of foreign demand for US assets. And that's why the 10-year isn't at 3.9 or 3.7%, which it was in September. There are ETFs in Hong Kong that trade at a premium to NAV just to access US markets. I bet they've declined by now. And now the America First approach has caused people to look inwards to their home markets and bid up their own equities. And in China, there was an article in Bloomberg, I think it was yesterday morning, how the China premier is laughing that, the U.S. has these trade wars with its allies. And so Besant, of course, knows all this. If you make, American capital markets the finest place to park your capital, which it is, and now's not a bad time to get back in when you've got Nvidia at a mid-20s PE and Google at an 18 forward PE. Like this is a nice time for rotation back into Mag 7 or U.S. equities more generally. But that's one. Then get on with the deregulatory agenda. Like,
Yep.
what are we waiting for on that?
But Joe, to answer your question, I'll go out on a limb here and I say the Fed isn't relevant anymore. The Fed was not able to produce the tightening it wanted to. I don't think it's going to be able to move the needle on the easing either, largely because its hands are tied around inflation. There's no way it's going to be able to cut rates sufficiently. Animal spirits matter a lot, especially for the risk assets that we all focus on. But the Fed is increasingly irrelevant. It is very much now down to fiscal, as you pointed out, and is very much down to the global flows of funds that Ram was referring to. And I don't think that's not going to change, especially given the size of the deficit spending that we have coming, in my opinion.
What are your thoughts on QT?
I think we're going to, hopefully, this comes out on Wednesday, I imagine, and we may have had the FOMC statement by then, but what I'm most going to be looking for is any indications that they're going to pause QT. This is something they've hinted at before that they might do, especially given some coming tightness in the treasury market. They might pause that. That actually would make a difference. It's not a huge amount of QT at the moment, but it's enough to move sentiment, especially in terms of the fact that there's not, there is a new buyer coming back into the market. They're going to not just let the bonds roll off, they're going to be in there replacing them. That's significant because that is quite a lot of money. And that is the only kind of easing they can do at the moment because their hands are tied because of the threat of inflation, and who knows what tariffs are going to do to the incoming price indications that we're going to be getting.
Yeah. So two things for me. One, this is an example of one of those ETFs that's trading at a premium. It's basically just an S&P 500 ETF that's listed on main short China. And you can see that this middle table is the premium. So we went up to 20, then went back down to under 5, and all of a sudden today we're back over, as of Friday, we're back over 20%. So some of these are back to trading at premiums. So there is, I guess, demand coming back from that China example you talked about. And then the other thing I would say that what Noelle was just talking about, the QT side of things, our rates analysts who I sit next to in this office, they're not here right now, but I've said in this podcast many times, we're nearing in and on the LCLOR, which is the lowest comfortable level of reserves, where like they need enough liquidity in the system just to keep things, almost like oil in an engine, right? And they went beyond that, which caused a bunch of rage and taper tantrum type issues. And was it 2018? I think I don't remember exactly, but one of those times, and we're basically nearing on that level of reserves that they're going to keep no matter what. So QT's going to have to end because they can't keep selling things off if they want to keep, some certain level of liquidity. And now I think the polymarket odds are basically saying they think it's definitely going to happen before May. I've been saying that I thought it was going to happen in Q2. And that's what's going to happen. But the one thing I would say is I always see like people specifically in crypto world think if there's no QT, then it automatically means there's QE. And those are two very different things. And it's like anyone listening to this, if you hear people telling you that QT ending means that QE is beginning, just don't listen to their opinion on any of this stuff anymore.
Well, and by the way, the BTFP, right? Like they created BTFP after the SVB collapse and the kind of shocks that were sent through the regional bank system. Did you know, what if I told you that it's zero, all that got paid back, and you hadn't heard a peep out of the media about that? Oh, maybe they could create a new funding program again, or maybe the discount window, or these other tools that they have at their disposal. But I think, I'm really warming up to this idea that Noelle is sharing, which is the Fed is irrelevant. Given the constraints that they have, I do fundamentally agree, though, that I'm looking for the same thing. Any dovish commentary around QT or any other, potential dovish commentary in general from Jay Powell at the presser will change the sentiment. Because if he continues to come out hawkish and then they, guide something to the extent that QT is not, ending anytime soon, I think you're going to see risk get absolutely smoked again.
Look, I agree. Any positive news flow is going to benefit risk assets and very quickly, and sentiment can turn on a dime here. Look, we get a peace deal that can happen, right? Trump apparently is discussing recognizing Crimea as a Russian, entity, for example. So this is a chart of a 30-year mortgage rate versus the 10-year Treasury. This is something Bessent's looking at. They've talked about lowering mortgage rates. Bessent, a few weeks ago, talked about how the spread of mortgage versus treasury has been coming down. I think with the ending of QT, this is going to help mortgage rates come down. And that's good for the real economy. This is why I've been investing thematically, going back to position around mortgage refinance ideas. Because I think mortgage refinance will go up. Mortgage refinance actually did shoot up in September. There's a short period of time when mortgage rates came down, and consumers are smart. They see their mortgage payment, and people respond to incentives, and then they go refinance. Again, the refinancing isn't anything at the volumes we saw in COVID. Those people are not going to refinance for a long time. But the sensitivity to refinancing is there. So, that's good for the real economy and housing.
I mean, I completely agree. And this is, I think one of the reasons you see Trump and Bessent talk about the mortgage rates coming down, the spread between the 30-year mortgage and the 10 being so important. We haven't had a refinance cycle yet. And it's super stimulative, right? I think if you start to see mortgage rates drop into a 5 handle, you're going to see an explosion of refinancing happen, which is stimulative to the business cycle. And also, I don't have ISM in front of me right now, but I think the most recent print that came out was pretty bullish. And are we starting to see the business cycle start to kick back up again? Are we going to see the credit cycle actually start to improve? We saw kind of green shoots of this in January. I haven't been able to check it recently, but that all of that is certainly possible if we can get the uncertainty out of the way and the sentiment to marginally improve.
I mean, I don't see any recession risk. I mean, I don't even see credit cycle risk. We had September 2023. If you had
spreads agree too, I would say as well.
Right. I mean, household assets are flush. Their home equity is significant, and even though there's a 10% correction, we still have significant runs in markets over the last 2 years. And corporate credit, I just can't find credit cycle. It's all CRE. And I think what's happening is people are going to kick out consumption. Everyone's staring at their TV screen, trying to figure out what Trump's going to do next and tariffs. And they are in this kind of state of shock over the last few weeks. But human sentiment has a floor and it has a ceiling. We can only get so excited, and then the novelty wears off and we go to somewhere else. And we can only get so despondent, and then we make peace with that, and then we get back to business. And
especially since we're used to the market going up. I mean, we have that muscle memory still. It would take a very big shock, such as another 10% correction from here, for people's mood to really start to think about that. Mood is bad right now, but mood is bad right now because there's been some change in tone in the economic data and because the market has gone down, but it's not bad yet.
Isn't it amazing that people are talking about, are we going to have a recession? I just find it an amazing question. The question, I think, is a reflection of sentiment. You want to be contrarian to that. Now, there's a legitimate question on risk assets and asset pricing. Like, what's the valuation relative to earnings growth in a world of competing assets? That's a legitimate question. But the recession, it's just so, I don't get that.
I completely agree. And the sentiment is actually showing up. The credit spreads kind of, they ticked up a little bit. CDX ticked up a little bit over the past couple of weeks. Nothing crazy, but I still struggle to see some massive credit event as well. Yet today, Goldman's out saying we're seeing a surge of clients hedging credit portfolios, proposing 10x gross payout hedges. So there are people that are really freaked out or expecting, given sentiment, a credit event.
Aren't those
look, a 10x payout is great. Go for it. But that to me isn't bound in the realm of reality as it relates to credit right now. And I just don't see this credit event that these folks are hedging against actually coming to fruition.
Hi, it's Matt Hogan, CIO of Bitwise Asset Management. Ever wonder why Bitcoin tends to fall during periods of market turmoil, only to turn around and recover sharply when sentiment improves? In this week's CIO memo, I explain why this pattern, what I call dip, then rip, happens nearly every time, and what you can do as an investor to profit from it. To read my memo, go to bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo.
Carefully consider the extreme risks associated with crypto before investing.
One place it may rear its very ugly head is, again, outside, sovereign defaults. We were talking about them a few years ago, especially during the pandemic. And given the trade war that we are now in, given the move of the dollar, we don't know where that's going to go. It's possible we do start to see some more of that, especially in the new US mood of you're on your own, fellas. So that could then trigger some other type of credit event that finds its way onshore to the US. I'm a bit more skeptical about
That's
the
fair.
credit outlook.
That's a good point.
I have two things on this. One is I think in order for that to happen, you need to have the types of tariffs that Trump is saying, right? I think that would be the way that you could see a serious hit to growth and recycling or changing of the way that trade works internationally, with specifically the U.S. That could cause a shock to have some sort of credit event in some pockets of, the U.S. market. That's the only way I could see it happening personally. The other thing I would say is what you guys were talking about is just because there's no recession doesn't mean there can't be a hit to risk assets. And this is a chart from Lynn, which is fitting because I associate her very closely with also the fiscal dominance type of narrative that Noelle has been a proponent of. And this is a great chart because it's just showing this like trend line of like, this is the international markets versus the US markets. And everyone's been talking this year about how Europe is outperforming. A lot of it has to do with like the expectations for earnings in Europe and these European stocks was so low and just so bad that like all you needed was some little tiny sliver of hope and like upward progress. And the US was the exact opposite. The expectations and earning growth expectations that were priced into the market, were insane. It was like the 2023 and 2024
well, they were reasonable and they were exceeded, just to be clear. They were just expensive.
No, it's about 2025 going forward. Yeah. I'm not 2023 and 24 were reasonable and they were exceeded. And that's why we've had such good performance. There has been good earnings, despite what Bitcoiners will say it's all fake. That's not really true. The earnings have been there. But like going forward, what was priced in going forward from like from December after Trump's election, things got crazy. So like you get into 2025 and all of a sudden you have all this tariff talk and all these things and things come off. And like that's this divergent we're seeing. But like you look at this on a grand time scale and like what's happened so far in 2025 is like kind of irrelevant. That's not to say it can't be a turning point going forward, particularly if you have these countries putting more in defense and spending more and stimulating their economies.
A scenario where kind of everything goes up because U.S. assets have corrected. Now international assets are getting a bid. China has an AI story around it. Europe is introducing fiscal spending. Inflation is coming down in Brazil. Like you kind of have a decent backdrop for a global, risk rally.
Yeah, and their PEs, their valuations are way more, amenable compared to like what we're seeing and what we saw in the Mag 7. I mean, I mentioned small cap was down 20% and the large cap was down 10, but the Mag 7 itself was also down 20% and Tesla down way more, as you guys mentioned. So like everything got hit.
It's all about what do you own, which is a question of positioning. Look at South Korea. It's up the most out of all developed markets, 3% today. It's also the cheapest developed market. I mean, one of the leaders in the index is SK Hynix, is making all this HBM memory for NVIDIA. And it's got a sub 8x Ford PE ratio, or Samsung's cheap. So these are just ignored market. And again, South Koreans were buying Tesla stock. They were buying Tesla dropped 50% in the last 3 months. Now they're watching their home market start to rally. So yeah, I think
they have currency issues. Again, Europeans, for instance, have lost so much money on their U.S. stocks since the beginning of the year, not just because of the decline in the market, but because of the decline in the dollar. And that further encourages the repatriation that Joe was talking about.
We got to talk about gold. I'm sorry. Like, can we just have like a couple minutes? I know we'll get to the crypto, but I feel like we've got to talk about gold because, as everybody's probably aware, it hit a new all-time high. I think it hit a new all-time high today, March 17th.
It did.
It's over 3,000 an ounce, or it's around 3,000 an ounce. Why? Why does gold keep rallying, Noelle, in your opinion?
Well, one, the stagflation trade, but two, just the uncertainty around the world. And a lot of it has been to do with physical delivery in the US. That's why Bank of England has been scrambling to try and get the bars on the planes. But we're not asking the right question, which is why is there suddenly a shift to physical delivery in the US, which is normally not physical delivery? And I think it's because people actually want to hold. It's not just a financial instrument anymore. It is resilience asset. And this then brings the next question, well, why is Bitcoin not rallying the same? Well, that's in a slightly different bucket because it is also a risk asset. No one would accuse gold of being that. It's a sign of the uncertainty around the world. It is the hedge that the traditional investors, macro investors, and sovereigns are turning to.
I think this is late momentum. I mean, obviously there's a China bid around it. There's the anxiety bid supporting gold. There's the, hey, it's real and fiat is deflating bid around it. But this looks like late momentum. By the way, this is a logarithmic chart. So you put this on a normal chart, this is the definition of a parabola. This is late cycle stuff. I think people by now probably not wise to do so.
Yeah. So the one thing I would say is, so like if we look at like one place that timed this really well was Costco, which started selling the gold bars in June of 23, which was right around here when it was under 2,000 an ounce. Obviously, so and I think a lot of it also is like the main buyers over the last few years. I mean, people have been talking forever. I feel like in 2022 and 2023 and 2021, like central banks are buying up tons of gold and it's not moving. Eventually, it's going to get up. That's the one thing that like came to mind that wasn't mentioned. And part of, I think some of that has to do with, we sanctioned Russia. We're doing a bunch of things with our treasuries. We weaponized it in a way that we had never done it before. And I think people are turning to gold, and they're not really turning to Bitcoin yet as much as many of the listeners here would prefer.
But that implies, though, James, that they're turning to gold instead of U.S. treasuries, which means there's less foreign demand, especially at the sovereign level, for U.S. treasuries. So where's the demand that the U.S. needs going to come from? Probably the private sector, because it is a safe haven. U.S. treasuries are a safe haven, but we do have to think that there's not necessarily new money going into gold. It's money that is being raised from other assets.
I got an answer for you that is a really good segue that we did not plan at all. It looks like there's movement on the stablecoin bill. It got out of committee. It's going to actually get voted on. They could be a new source of demand if they're actually obviously Tether is one of the largest holders of treasuries and U.S. debt. There's a lot of, I don't know if anyone's really dived in or dove into like exactly what the nuances here of this proposed bill. But it looks pretty good from my point of view. Obviously, like I've said on here a million times, these people in the space, crypto, like you're going to get rules and laws and regulations. You're not going to like all of them. But I think for the most part, from the stuff that I'm looking at and from my personal point of view and what I would expect it to look like, it looks pretty damn good to me. Like it's kind of like what everyone kind of wants if we're going to do this sort of payment on the DeFi and crypto rails. And what better to do it than stablecoins? I don't know. You guys have any strong thoughts on how the bill looks, if it's bad, good, or whether it's going to pass?
I'm certainly biased because I'm an investor in Circle, but I do like
good disclosure.
Yeah, I'm an investor in Circle. But take Circle out of it for a second. If you look at it's hard not to look at Tether and be like, if this can be repeated, there's a huge potential buyer of U.S. treasuries, and we're kind of propagating digital dollars around the world. Like, it's not that hard to make that logical leap, right? The question is, we have one data point, which is Tether. And so will, this bill light up, further light up Tether, light up Circle and the USDC, PayPal, and frankly, the myriad other folks that are attempting to launch stablecoins as well as, kind of a latent set of demand for U.S. treasuries. I think that narrative could work really well. Is it going to be in the magnitude of what's required for the treasury? I don't know. But I have heard this narrative which I completely fundamentally disagree with. And I mean, I would love for, Noelle and Ron, if you guys have a view on this, to challenge me on this. But the notion of that the U.S. Treasury auctions will not clear at some point. I've seen Ray Dalio talk about this, and the guy's brilliant. I have nothing but great things to say about him, but I just think he's dead wrong here. Part of the reason that these U.S. Treasury auctions have to clear is that if you all of a sudden don't have a Treasury auction clear, then what is the value of a U.S. Treasury that's sitting in the reserve banks all around the world, right? What you thought was risk-free or what you thought was like the best form of collateral in the world, which is used as collateral for other things, is now wrong. And so on the one hand, I could see how the stablecoin bill could potentially create like a repeat of Tether with other companies that could provide latent demand for treasuries. But on the other hand, even if it doesn't, I still don't understand this concept of like the treasury auctions not clearing. Like they actually have to clear. Like it's just the way that it works.
Right. Rates will cause them to clear at some rate.
Rates
And
will go up.
And not just rates, but also the regulators. I mean, all the regulator needs to do is say to the banks, I need you to buy these treasuries. What do you think?
Exactly.
I agree. I don't think there's an issue. I do think this idea of gold versus bonds is a really interesting one. I think, Noel, that you shine a light on. Look, gold is the safety trade, and it's got positive carry because it's going up and it's making money. So the gold trade must die. That's what it must be. The gold trade must die so the U.S. can refinance its debt. The bond market must be the safety trade. That should be the objective of Besson.
Yeah, and the one thing I would say is like there was a lot of concern I saw like when this first came out that it might like make Tether completely illegal and not able to hold treasuries, which doesn't actually look to be the case based on my understanding of how it looks. But basically, Tether could choose to fully come in and get lit up and be covered by the regulators, but they don't actually have to do that. They just wouldn't be able to be used as like cash equivalents for different accounting margins, be used for like interbank settlement collateral. Like they just wouldn't be able to be used in like the actual plumbing and infrastructure of the TradFi world, I guess you would say, or the financial system. But they don't have to do that. I mean, they're not doing that now, and they're plenty successful. So it kind of, I would be very interesting. Like if this finally gets through, like is Tether actually going to go in and like try to comply with everything here, or are they just going to sit and idly by and just be happy with what they have? Or do they just spin up something else completely different that actually is fully lit up and meets these requirements? It'll be interesting to see how it plays out. But then obviously you have the circles and plenty of other people. Every bank I feel like is going to get into this game, right? Like we talked about this last time. Yep. Like every bank is going to get into this game because even if it's competitive with their current business model, like they need to understand how this is working, see their demand is going, and play around in here. And that's where we're going in the next few years, particularly if this thing gets through.
James, check out this link I put in the Telegram or chat. If you can play that, it's Elon Musk talking about how there are 8 or 9 different computers where they just make the money and then spend the money, and it links back to how do you pay for your debt, and can you get a sovereign default? Can you get a decentralized ledger to create some accountability?
Yeah, I saw that. I confess I did not understand what he was talking about. Does anyone know?
Let's take a look, then we can react. But yeah.
One of the things you told me about is what you call magic money computers at the treasuries. So tell us about it, because I never heard of that until you brought that up.
Okay, so you may think that the government computers like all talk to each other, they synchronize, they add up what funds are going somewhere, and it's it's coherent. There's and that the numbers, for example, that you're presented as a senator, are actually the real numbers.
One would think.
They're not.
Yeah.
Okay. I mean, they're not totally wrong, but they're probably off by 5% or 10% in some cases. So I call a magic money computer any computer which can just make money out of thin air. That's magic money.
So how does that work?
It just issues payments.
And you said there's something like 11 of these computers at Treasury that are sending out trillions in payments?
They're mostly at Treasury. Some are, but there's some at HHS, some there's one or two at State. There's some at DOD. I think we found now 14 magic money computers.
14, okay.
They just send money out of nothing.
But basically, I don't know. It kind of was like, I don't know, money's created when banks are like doing lending and stuff as well, was my initial thought when I saw this. But I guess like this goes back to like Larry Lepard, who's doing the circles for his book that he just wrote. He talks about how like you're just pushing a button, printing money. There's no work. There's nothing done to produce that, and why he's like so all in on Bitcoin. I guess you can make the same argument as gold. Somebody went through the process of digging it out of the ground, essentially. But yeah, I don't know. It was a weird clip. Ram, obviously you had some strong thoughts on it. What was your view?
Well, I think we're in the age where people are forced to think critically about matters that they didn't have to before, because Trump is appending many prior conceptions, good or bad. Like I'm a believer in free trade. I don't think we need to revisit that idea. I think David Ricardo got it right, and Adam Smith got it right 300 years ago. But this idea, people in crypto have talked about these issues around fiat for a long time. And a lot of people struggle to connect with the idea that the Federal Reserve can create money in a computer database. They struggle to make that connection, or that maybe there's a significant amount of waste or other kinds of issues out there. So
from the clip, at least what I got from it was Elon was kind of blown away that there's a handful of computers at U.S. Treasury, the Department of Defense, HHS, a handful of government agencies that receive invoices and just pay them, but the payment is not attached to a bank account balance. Literally sending money, but where did the money come from? I've had this running joke. If you follow me on Twitter, I've been doing this for years, where I say, like, what if I told you it was all made up? Like, it looks like it's all made up, right? Like, it looks like it's just an entry in a database. And in fact, just this past weekend here in Miami, I was on a boat with some friends. It was buddy's birthdays, late 50s, and no exposure to crypto. And he's like, I don't understand it. You know, I'm just a stocks guy and like cash and whatever. And, and I'm like, but do you hold the stock certificates? And he's like, no. I'm like, do you hold cash? He's like, no. I'm like, your money is an entry in a database that you actually don't know exists, right? And that's what's so alarming about this video is that, to your point, Ram, like a lot of these conspiracy theories or preconceptions of how money is actually generated and licensed, if you will, throughout the system, people just didn't really want to believe that it was a magic internet money machine or whatever Elon calls it. Turns out that's actually true. Because let's be clear, I don't think you can like or dislike Elon as a person. The guy is not making any money doing this. In fact, he's losing a huge amount of his wealth if you look at his Tesla stock and probably the privates for SpaceX, et cetera. Why would he just randomly make this up? Like, I'm pretty sure he's, such a hardcore engineering mind that he was like, I can't believe that this computer can just send out money that's never been made before, right? Like, that's probably what actually happened.
Yeah. And isn't it absolutely amazing, Joe, how many people we know that work in finance? I used to work in traditional finance, and I thought I understood money. And it wasn't until I discovered Bitcoin that I realized I didn't understand money at all. And how many people do we know that work in traditional finance today that don't understand money? And this brings us a good segue into Bitcoin as we're heading into wrapping up here. We often ask ourselves, where's the new money coming from? In my opinion, it is going to be coming from everyone who's suddenly realizing, holy shit, this is not what I thought. Holy shit, we have a new type of money in our midst. Holy shit, there's a new type of asset that is going to change the way we think of stores of value. It's a whole new market out there that doesn't yet understand, but will, especially if things continue to, shall we say, hint at going off the rails.
I completely agree. And like, whether it's DOGE or it's this magic internet money machines that they're finding, I think some of the hysteria around it is very partisan and very like politically one-sided for the most part. But it is shocking to have this stuff come to light where we're figuring out or we're finding out where this money is going. I mean, like I run an investment firm. Like, I have to have my financials audited every year. It is a major pain in my tuchus to do that. The Department of Defense hasn't passed one in how many years? And it's just okay? What? This doesn't make any sense. And so by shining a light on a lot of this, I think, yes, you're going to have people really panic and freak out, and it's chaotic and it's hysteria. But maybe by, I don't know, upgrading the systems with arguably the greatest scientist, at least since I've been alive, at the helm of that, it feels like it's going to be better longer term for the US government and, frankly, the United States of America. However, by shining that light, to your point, Noelle, people are going to realize that it's all made up. And if you actually find an alternative financial system, Bitcoin and other parts of crypto, maybe you should participate in that one as well.
The big reset that we were talking about earlier. Now's the time to do it, because literally when else?
There was a question that Lex Friedman, I think, posted DeepSeek a few weeks ago, and he said, tell me something that's distinctively human. Then DeepSeek does a deep think, and it says, humans are the only species that will create stories and myths about the meanings of things like money and borders and some other concepts too. It's true. and they call it a collective hallucination. The AI is telling us that we're hallucinating around these shared concepts, which is exactly true. I think what Elon did is he made operational and physical this intellectual idea of money creation. He said, here are the 8 computers, and I saw their registers, and you're like, there it is.
Yeah. Well, by the way, I mean, there's precedence to what the DeepSeek response was. They've likely got trained from Yuval Harari's book *Sapiens*, because he talks about this is years ago. It's an amazing book.
I think Yuval's a little off on the AI stuff, but *Sapiens* I thought was a great read. And in there, he talks about human beings in like once we got past kind of hunter gathering, we were doing agriculture, and we were in groups of more than 150 people. You actually had to invent stories to get people to all agree and do stuff. And what are the 3 things? Religion, politics, and money.
It was shared cooperative mechanisms. Said humans create stories and systems around symbols to create cooperation mechanisms. I was like, yeah, if you had to write a 1-sentence book report on human civilization, that would be it.
All right. Anyone else have anything else on Bitcoin broadly, or what we were just talking about before I jump on to Solana futures and ETFs?
I'll say, look, animal spirits can rally here. Bitcoin's on long-term support on a long trend line. Of all the assets in crypto, Bitcoin is a shot to rally here. If it doesn't, then watch out. It's right at the trend line, but historically has. So that I think is notable.
Yeah, I also would say, unfortunately, I don't think there's going to be an alt season. I know that's probably from someone who likes alts. I don't think I think Bitcoin dominance, I've been saying this for a long time. I just don't think it's topped yet. And to Ram's point, it's probably one of the assets, if not the crypto asset, that's down the least in this pullback. And dominance is rising. So, I struggle to see a scenario beyond various idiosyncratic events for various tokens to have, massive outperformance to Bitcoin. And I'm not even sure what would actually trigger an alt season because of Bitcoin's rising dominance. And historically, it's been retail that's been participating in bidding up a lot of, the altcoins. Well, they've been buying meme coins, and now they're decimated on that as well. So I think retail's like, I'm good at this casino, right? So then it raises the question, like, and this is I thought that I have a analyst that works with me at Asymmetric. We've been thinking about this. What would actually cause a bid for alts? And if it's not retail, is it institutions? And I know that sounds crazy because why would an institution buy Maker or, Lido or Jito or any of these other kind of, Uniswap, you name it, right? Any of these tokens, why would they do that? And the only thing I can think is maybe that there is, an asset issuer that's progressive enough that just wants to ETFify everything. Sub 1% chance of that, maybe, but unlikely. Or they actually start to do real fundamental analysis on some of these protocols that are generating real revenue and saying, hey, this can look more like a stock. Therefore, I can actually package this up or find ways of actually bidding it. I think this is a long ways out, to be super clear. I don't think this happens anytime this year. But if there is no retail bid behind alts, Bitcoin, I think by definition in the crypto asset space, has to benefit the most on a relative basis.
Yeah. Flight to quality.
Yeah. Joe, I want to ask you a question. What do you think the impact of the CME SOL futures is going to be?
Great question. So
to reiterate, they listed today. So we're recording this on March 17th. So they started trading today for anyone.
So I think from a trading perspective, short term, I don't think there's going to be a huge impact. But the signal that it's actually sending to, I think, TradFi and institutions is pretty powerful because we've had Bitcoin and Ethereum for a long time. James is the expert on the ETF stuff, and now there's an observable market, right, with the CME futures. Will that just then become another basis trade for hedge funds? Potentially. There's no SOL ETF yet, but when that launches, you likely see a lot of flows into the ETF, but also a lot of shorting on the future side. I just think that the broader signal that it sends is like, hey, there's actually a third cryptocurrency that is in the realm of a Bitcoin and Ethereum in terms of its appearance to institutional investors. So like we're likely not going to trade it because we really don't need to. We don't have we don't run basis trades with, an 8% or 10% annualized yield. It's just not part of our strategy. But there are a lot of TradFi funds that will. And even with the Bitcoin ETF or the Bitcoin basis trade with the ETF and the futures, once it's above 10% annualized, they tend to pile into that because that's a lot for a TradFi fund. That's not a lot for a crypto fund, right? So I think that the signaling is super important. When the ETFs come to market, I'll probably have a much more informed view as to how important this listing actually is. But the fact that it's even on the CME to me is, as a longtime Solana bull, on almost the 5-year anniversary of Solana. Yesterday was the 5-year anniversary. So it is pretty remarkable to see it come to fruition.
So I have a few things to add. One, I would say is like you were talking about like what sends an altcoin rally. I would say one, you now have the government basically endorsing, Bitcoin is distinct and separate from everything else. So it's not just other people saying this, right? Like this is literally the U.S. government via executive order, albeit that's saying that as well. So I think that's part of the reason. I don't know how much that plays into it, but it's definitely part of the zeitgeist. The other thing you were asking about what other demand could be, we are going to see index funds of the crypto space. The problem is these altcoins that would go in there are going to be very small percentages. Like if you do by market cap, it's going to be like 80% Bitcoin or 70 something percent Bitcoin, 20% Ethereum, and then everything else, if whatever else is in there. So it won't be a ton of demand. The other thing I would say that could possibly do it, that goes along with what you were saying, Joe, it's like just to additionally add on to what you're saying. If we do have rules that come out of the SEC and the CFTC where they can flip those switches, where they can share revenue, and it's not going to automatically get them a Wells notice and get them into a lawsuit with the SEC. If there's some rules and regulations around that, all of a sudden people can see, oh, wow, there actually is revenue being generated on these chains for doing different things from the likes of, Solana, Ethereum, you name it. There are a lot of things. I mean, Uniswap is a perfect example of something like you just flip that switch and all of a sudden it's like, oh, wow, they're actually making a bunch of revenue here, and TradFi people are going to like that. And then the last thing I would add is on the basis trade. I wrote about the basis trade last week. It was one of my most read notes in a while. And basically I was saying we've seen $5.5 billion come out of the Bitcoin ETFs, which is a big deal. It's a record coming out since February 10th. But a lot of that is almost certainly from what you were talking about, Joe, from like the beginning of December until the end of January. There was points on days where you were earning 25% annualized returns. Now, granted, you're not getting 25% in one day, but if you could keep those types of yields going forever, you would have earned 25% virtually risk-free. So like you were well into double-digit territory on an annualized yield basis, and hedge funds piled in. That's why there were so many new hedge funds that were in there at the end of the 13F filing at the end of December, because people piled in. That yield went down well into the single digits starting in early February. And that's when likely, I'm not saying that's all of it, like undoubtedly there's probably people selling, prices way down, but like a lot of the flows specifically to come out of the ETFs are almost certainly have come from that sort of basis trade from the hedge fund side of things.
Completely agree.
Interesting.
Should we get into ETFs? Okay, I'm going to share my screen here. I'm going to share this file that I maintain, which is, I'm going to have to scroll to share it because it's just kind of crazy. This is my file that I maintain.
I imagine you have a table of 85 ETFs about to launch. That's the punchline, right?
It's literally a line, and there's like, these are all the filings that have been, anything green has actually been approved. But these are, and this isn't even all of them. So some of them include like filing for in-kind, filing for options, filing for staking, all these individual tokens. Like there is a lot of stuff in front of the SEC right now.
Actually, James, can I give you a quick plug here? I tried to keep track of all of the filings for the ETF, and I had my spreadsheet, and I had the 19Fs, and I had the S1s and everything. And eventually I gave up because I'm thinking, James has got a handle on this. I'm going to wait for James to publish his.
Yeah, so I maintain this as the best I can. There's probably stuff I missed because there's like, it's crazy. And one thing the SEC did last week was they kind of like kicked the can down the road on anything that was remotely coming due in the next month or two. And it makes sense. Our view has always been they're not going to actually approve anything before options on Ethereum ETFs. Their final deadline's in like early April. So that's the only thing I could see getting through because it's the final deadline. I don't think you're going to deny them, but everything else, they're not going to do anything until Atkins is in his seat, right? Like, I don't care what their view is. I don't care what Hester and Ueda are going to do. They're not going to go through and just change the trajectory of different things without, assuming Atkins gets into his role. So that's been our base case. That seems to be what's coming out of the SEC and what the SEC might be telling issuers based on news reports. But there's a lot of things coming. And right now, I think we could see a Solana futures ETF launch potentially before the end of the month. I haven't seen much movement on it, but volatility shares filed for one. So there's a whole bunch of different issuers that have filed for leveraged Solana futures ETFs, XRP ETFs, different things like that. So they're coming, and there's a whole bunch of different spot ETFs that have also been filed.
Way too many spot ETFs.
Have any of the big names? I read the other day Franklin Templeton have filed something, but have any of the other big names, the traditional asset managers, filed for anything that isn't Bitcoin or ETH?
So Franklin is in on, they have a basket ETF that they filed, and they've also filed to basically, what it comes down to is you have Grayscale and Bitwise have these over-the-counter trusts or funds that trade at premiums and discounts like the Grayscale Trust used to, and they're filing to convert those just to full-blown ETFs. Then you also have Hashdex and Franklin, which filed ETFs that are Bitcoin and Ethereum, and they've also filed 19B4s basically saying, let us add all the other tokens from our index that this fund is supposed to be tracking. Like it always said from the get-go they were going to do that. So that's the number one thing. And then you have all the other ones, Litecoin, Solana, XRP, Dogecoin, Cardano, Polkadot, and HBAR have all been filed. But Franklin's the only one of like the TradFi manager. But we have, I mean, you're looking at Grayscale has filed for every single one I just mentioned. Wisdom Tree has filed for XRP. Van Eck has filed for Solana.
Wisdom Tree did XRP?
Wisdom Tree filed for XRP, yeah.
Oh, I know. Who we send a cease and desist order to.
So XRP is the one with the most filings on it from an issuer.
Well, it has a market cap greater than ETH for like a hot minute this weekend. Yep. Is that still true today?
I don't know, actually.
From an FPV perspective, yeah, it's been flip-flopping back and forth.
Yeah, crazy.
Just a quick note here that when Ram said Ripple's market cap, he meant its fully diluted value.
But yeah, I mean, everyone's filing everything. They're waiting to see what's going to happen. Our view is kind of like nothing's happening till Atkins gets in, but I think we could see stuff move before the ultimate deadlines. All of them have deadlines in October. The only thing with deadlines earlier than that is those index funds I was talking about, specifically Grayscales and Bitwises. Their deadlines for their 19B4s is in July. So at the very latest, our expectation is we're going to have approved index funds that hold way more than just Bitcoin and Ethereum in an ETF wrapper in July.
So first off, I agree with the point that altcoin season's dead. Rapid product proliferation that's top signal kind of stuff.
100%.
Obviously already topped us behind us, and it's kind of, I don't know if this really does much, but I don't know. I think sometime this year, though, digital assets as a category, including Bitcoin, hits peak.
Is there any indication on when Atkins gets into a seat? I know Gensler wasn't approved until April of the previous administration. Any idea when Atkins goes before the committee?
My understanding is probably sometime in April. I think Gary, like you said, it was mid to late April when Gary was ultimately confirmed. So it could go into May, June at the absolute worst, from what I understand, talking to people. But I don't have any inside knowledge of when his hearings are going to be. But he's also not a controversial chair. Right, like he's not the likes of our defense secretary and different positions that this administration has put people up. He's liked on both sides of the aisle from what I can gather and talking to people in DC.
So he'll get it. It just has to go through the process, and that's when they can start the approval schedule.
Yeah, believe it or not, getting in your SEC chairman is not as important as getting through Attorney General or Secretary of Defense or Health Secretary, you name it. So
who knew?
Yeah.
Did you guys see that Solana Accelerate video going around? I thought it was kind of funny. I thought it was pretty funny. I don't know if they intended this or not, but the guy is kind of tall and lanky like Vitalik, except I think he's a carnivore. That's like the meta joke in that video, I think, right? I mean, the contrast.
I mean, I think I saw the video just like everybody else did, but I think that, the Solana team and community has for a long time really wanted to focus on building and innovation. And, the founders are American citizens, and a lot of the folks that work at the foundation are Americans. And I think it was obviously satire to some extent, if not fully, to promote this conference that they're doing that I believe is going to be in the United States. Whereas they haven't really had, Solana, I should say, has been associated with various SEC lawsuits and these types of things. And so I think the poking fun at the focus on ideology versus actually building and accelerating, as to what they're describing, was pretty spot on. It's definitely going to piss some people off. That's for sure.
They lean into the zeitgeist. No question.
All right. All right, we'll wrap up. Went a little long again today, but this was a fun one, and it's good to get four of our recurring guests on at once. This was great. All right, everyone. Thanks for joining us for this episode of Bips and Bips. We'll be back in 1 week to discuss more about how the worlds of crypto and macro are colliding. Until then, everyone.